Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. In this week, we're going to be talking about ESPN and ESPN Plus after Disney reported their fourth quarter earnings last Thursday. But before we do that, I want to say, just remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. So, shares of Disney climbed late last week after the company reported better than expected fourth quarter results and record full year revenue and earnings. The shares opened slightly lower Monday, but overall it was a good showing for Disney last week. And I want to just get into a little bit of Disney's results, non-specific of ESPN, to kind of put everything into perspective of where the company is headed and how important ESPN is to them going forward. So you had Disney's adjusted quarterly earnings climb 38%, easily beat our Zacks consensus estimate. Revenues climbed 12% to reach roughly $14.3 billion, which also came in well above our $13.8 billion estimate. So those top and bottom line beats helped last week. And then in terms of specific units, you had the parks and resorts unit. So this is their theme parks and resorts. They climbed 9% to $5.1 billion. But the big standout last week in terms of just year over year growth was the studio entertainment division. That division's revenue skyrocketed 50% to $2.2 billion. And our estimates had called for a 27% jump. But we should remember that studio entertainment, just because of the nature of the business of the box office and when movies are released, is always Disney's most volatile segment. For instance, studio entertainment revenues sunk 21% in the fourth quarter of 2017. And then just last quarter, they surged 20%. So it really just depends on what slate of movies is coming out at what time and what they were going up against in the year a prior quarter. So, for instance, this quarter, you had Incredibles 2 and Ant-Man and the Wasp going up against just Cars 3 in the year ago quarter and no Marvel movie. So that's why you can have this massive surge. And both those movies did fairly well. So, once again, this parks and resorts business, or not parks and resorts, the studio entertainment is always going to be a little volatile. And then some other big news that will be key going forward for Disney, which has been in the news for some time now, is that the EU finally approved their deal to buy some key 21st Century Fox media assets. So now you've had the EU, the U.S. Justice Department, and both company shareholders have approved the deal. Disney now anticipates that it could close a little earlier than they expected. And as I said, it will play a big role in Disney's future going forward, especially in their streaming future. And then some really big news, and what was all over the place, is that on the conference call, Bob Iger and Disney executives got into their plans for their standalone Disney streaming app, and they also released its official name, which I think it was a little underwhelming to some people, but also kind of follows what they've done so far. It is now just Disney Plus with just the plus sign. So they've done ESPN Plus and now Disney Plus. Very original in that camp. And that will launch in late 2019. And they will try to have that take on Netflix and Amazon, and soon enough Apple is going to have their own streaming service as well as AT&T. And they didn't get into any real price points specifically yet. They said they would show off what the app is going to look like at an April investors conference. But last quarter, Bob Iger said that since the Disney app would have less volume than Netflix, that their price point would reflect that. So we'll see. And then he did mention that in terms of what the app will look like, that unlike, say, Netflix or Amazon, where it's a little bit more, it's categorized by, say, action movies or comedies, this will just be broken down into Disney, Pixar, Marvel, Star Wars, and then eventually National Geographic. And now that we've done the little quick Disney overview to see what's going on with them, they had a pretty solid fourth quarter. How did the media networks division, which which houses ESPN. How did they do? Did pretty well, but we'll get into some more of the details. So Media Networks, which is comprised of their cable and broadcast division, that revenue was up 9% to roughly $6 billion, came in above our $5.7 billion estimate, and once again accounted for the largest portion of revenues at around 42% of overall Disney revenue. So it's a really important division and will continue to be for the foreseeable future. And then specifically the broadcast revenues were up 21%, so broadcast did really well. And then ESPN-driven cable revenues were up 5%. But the big 21% jump for broadcast was because they sold 2 Marvel series this quarter as opposed to just 1 last quarter. So that's that big jump. And then for the year, Media Networks was up 4% revenue and cable was up 3% for the year. But the operating income was down 6% for the quarter and down 4% for the full year. And it's kind of, if you think about it, it's clear why the operating income was down, and then going forward, it's going to continue to go down because they're spending more money on this streaming ESPN Plus push. So they said specifically that the operating income being down was due in large part to a loss at BAM Tech, which is the streaming company that Disney now owns a majority of, that works with the HBO, NHL, Major League Baseball, PGA Tour, WWE, all these companies for their streaming, and it reflects, quote, content and marketing costs and ongoing investments in their technology platform. So they're going to keep spending on ESPN Plus to make it bigger and better, and eventually, whenever it happens, to be ready for a real, truly standalone ESPN streaming service. And now I want to get into more specifically just what's going on with ESPN, and then we'll get into any new ESPN Plus news that we found on the conference call. So ESPN's operating income for the quarter was down, and it was offset primarily from higher programming costs and lower advertising revenues. The increase programming expense was driven by contractual rate increases for the NFL and college sports, so they're spending more money to broadcast Monday Night Football and their big-time college programming, and then ad revenue at ESPN was down 6% in the quarter, and this was due to a decrease in viewership and lower units delivered. And then you had affiliate revenue growth was due to contractual rate increases, and then it was offset by a decline in subscribers. So this is really going to be the story you hear from ESPN and a lot of companies for some time, is that their advertising revenue is going down. Luckily for ESPN, some of this is being offset by they're charging people who still have ESPN on their cable packages more than ever. And then this is just kind of going to go with how does it work out with the viewership going down, therefore advertising revenue going down. And I've talked about this before, but it is shocking when you think about it almost that for all the talk about ESPN struggling, ESPN charges over $8 per subscriber each month for carriage on cable or satellite packages, which is the most by far of any network. The next closest one is Yes Network, which is owned by Fox, and that is a big New York regional sports network. They charge $6.37 to each subscriber. So ESPN charges over $8. The next one is $6.37. And then this brings me to something that is worth pointing out, that in this new big Disney and Fox deal where they're going to sell, Fox is going to sell their TV and movie studio as well as some other assets, that Disney has to divest Fox's 22 regional sports networks as part of their $71.3 billion deal with 21st Century Fox. And this includes some pretty huge properties in New York, like I mentioned, LA. In the regional sports networks alone are said to be valued at around $25 billion. Though, based on some Wall Street Journal stories I was reading, they think they'll grab more likely between $16 and $20 billion, depending on how they sell these packages. But as I've said now a lot on the show, that these live sports is really still a huge draw for TV because that's where they can get advertisers. And now I want to do a little bit more on ESPN Plus and anything else we learned about ESPN from the conference call itself. But before we do that, I just want to quickly remind listeners or those who might not even know what's going on yet with what exactly ESPN Plus is, because you're going to hear a lot about it with Disney Plus now coming out next year. So ESPN Plus launched in April, and by September, it had already reached 1 million paying subscribers in around 6 months. Disney said that was a huge, huge win for them. So I didn't know. I mean, I don't know what they were expecting. So a million sounds about right, especially when it's not carrying a lot of their primetime sports coverage. It costs $4.99 a month, so not super pricey, and then $49.99 for the year. And as I said, it doesn't have the big marquee stuff. There's no Monday Night Football. There's no NBA basketball. There's no big time college football or basketball that you would get on regular ESPN. Instead, they're having some NHL stuff, Major League Baseball, lower-end college sports, and non-major college sports like lacrosse and all that stuff. And then also it's very soccer-heavy. There's a lot of MLS coverage. They got an Italian soccer league where Cristiano Ronaldo now plays. And then UFC, you're going to hear some UFC talk on ESPN because ESPN landed the rights for UFC. That's going to start happening in January on ESPN / a lot of it's going to be exclusive to ESPN Plus. So that could be a big draw for the app as that combat sport becomes more and more popular all the time. And then at the moment, Bob Iger, CEO of Disney, said that they're continuing to see what he said was impressive growth. Didn't get into any details about that for ESPN Plus, and he sees that continuing going forward. And he believes that that's kind of like bode well for their Disney Plus direct-to-consumer push overall. And as I said before, Disney is spending a lot of money on ESPN Plus. They plan to spend about $100 million in the first quarter on ESPN Plus. And then I want to just give a little quote about their overall plan and kind of what's going on for ESPN Plus. Clearly, it's working in terms of interest from users and subscriptions, which continue to grow. From what we gather from research we've seen and just generally anecdotal information, it's a product that is considered a good consumer experience, easy to navigate, easy to use, very high quality in terms of the quality of live streaming. And this is something that's going to be really key going forward, is that when eventually down the road ESPN goes to a live, everyone's going to be on some type of streaming for ESPN service down the road, 10, 15, maybe even 20 years, where it's not attached to cable necessarily whatsoever, that the quality of the streaming of live sports has to be good because no one wants lagging live sports ever. And then he talked more about their products and what they're offering. He said the soccer coverage has done really well, and he said they also have seen some nice college football numbers of that, like I said, the non-big marquee stuff on there. And then he pointed out that UFC, he expects to be really good for that service when they roll out those fights in early part of 2019. And then they also talked about customizing the platform going forward and then really marketing as a college specific to people who don't live near the college they went to, or they don't get any of those games, that you could market it as, hey, you went to, say, I don't know, Penn State, and now you live in California. You can get this ESPN Plus package, and you can watch every Penn State college game, whether it's football or baseball or basketball or anything like that. So they're going to try to start doing that going forward. And then someone on the conference call raised an interesting question, and this is something I hadn't really thought about, and this is more just about ESPN in general and its role within Disney. And they asked if they ever plan on putting more sports back on ABC, because at the moment, in terms of broadcasts, companies, CBS, NBC, and Fox offer way more live sports than ABC, which seems all too obvious because ABC didn't get any of the good coverage because Disney wanted to give it all to ESPN because that is their sports leg. And Bob Iger without saying it straight up, said they have no plans to put anything real sports heavy back on ABC anytime soon. They do have NBA Finals games on ABC, and then later on in the season they have some NBA games on Saturday nights. But besides that, there is not much live sports coverage on ABC whatsoever, and they don't plan on changing that anytime soon. So those are really all the updates we had on ESPN and ESPN Plus. Nothing groundbreaking or earth-shattering here, but it's worth noting some of the updates. And then I want to just talk in conclusion a little bit about the overall cord-cutting numbers and some of the recent numbers to put everything even more into perspective of why Disney's doing this streaming push now with their new Disney Plus standalone direct-to-consumer product, and why they've slowly are trying to roll out this ESPN Plus and see what works, see what they can offer, and really see why and what is going to happen for them going forward with this ESPN standalone product. So overall, you have cord cutters in the U.S., consumers who have canceled traditional pay TV service and not resubscribed. So when you hear cord cutters, that's what they mean. It doesn't mean people who just don't have cable, because there are younger people who have never had cable. So cord cutter means at one point you had cable and now you don't. That number is expected to climb to 32.8% of U.S. adults. So 33 million adults are in 2018 expected to be considered cord cutters. And this is by eMarketer figures. And then you also have the traditional U.S. pay TV subscribers. So this is people who have cable or regular television, satellite, whatever. That record or that number is supposed to drop 3.7% this year to 94 million households. But you still, overall, you have 187 million U.S. adults, because obviously there's more people who live in households than the actual number who are like specifically paying for the package, are going to be watching traditional pay TV in 2018. So it's still way more. So 187 million to 33 million, this cord cutters to traditional pay TV people. But it's a trend that's going to continue to go this other way. And then these raw numbers of how many subscribers people are losing a quarter in terms of, so the top cable companies lost around 305,000 subscribers during the first quarter of 2018. And that was actually an improvement from 2017's first quarter, when they were losing about 515,000 people a quarter. And this is each of the big cable companies themselves. And then in terms of these streaming companies that are attracting these people to not have cable anymore, based on eMarketer results or studies from July 2018. So these are most likely going up since then, but these are the most recent numbers. The number of people watching Netflix at least once per month in the United States is expected, or was projected to be 148 million people watching Netflix at least once per month. And then the next closest was Amazon Prime Video at around 89 million. And then Hulu was at 55, HBO Now at 17. And then you had Dish's Sling TV thrown in there, which is kind of a separate thing from that, at about 7 million. So a lot of people are watching all of this now, and this is something that I've talked about, is you're going to get to this point, though, where all these other services are now competing for people, and you're going to have Disney and Apple and Netflix and Amazon and Hulu and HBO, and that's going to end up starting to cost people more and more money, and we'll really just see where it goes from here. But in terms of pricing, cable is becoming less and less affordable for most people. So it's going to be an interesting next 5-10 years of this transition of where does cable go? Can the costs come down to attract people to stay in these services that are, I mean, if you look at Netflix, for the most expensive package is $13.99 a month, and that lets 4 people watch at once. Amazon Prime costs $12.99 per month. I mean, right there, that's a decent chunk of money, and then Disney comes in, whatever price point they come in at, even if it's $8 a month or something for their slimmed down version in terms of volume. All of a sudden you're paying a lot of money just for 3 services, and you want some live TV in there as well. So as I've now said a couple times already, it's going to be really interesting to see what happens, because at some point you might end up just having all of these things packaged in some type of cable type package sooner than later, because you can't afford to have, people just can't afford to have 10 different services that cost $10 a month, or all of a sudden why are you getting rid of cable, because it ends up costing you more because you still have to have the internet from that cable company likely in the first place. But that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.